Kawaoka here join us. Thanks so much for being here. We'll give a quick intro to what Coast2Coast is and also a little bit background on Lane, and then we'll get into more of a conversation format. And then we're going to also do breakout rooms, and it depends on how many people joining us. We might have one to two or maybe more. And so, real quick on Coast2Coast, it was kind of formed with a few of us here on the call. We got Vivek and James, and also Peter was there at the a recent, well, actually been a year or longer, a boot camp where we learned about multifamily investing. And then we kind of started around the same time. We all each have a little bit of real estate background, and we can work, learn more as we started a group and created a Facebook group and sharing information, knowledge, and maybe hunting deals together. So that's we're now I think approaching somewhere in the more than 100 members in the group, and we're active looking for deals and talking to sponsors and other real estate experts to kind of get their expert opinions on what's happening in the marketplace and what they can share with us. In the past, we also hosted a few kind of monthly webinar on what's the state of the economy and also kind of real estate. And we also created a newsletter for that as well. So if you're interested to learn more about what we do, you can come to the m5capgroup.com to look us up. So that's kind of in a nutshell what Coast2Coast does. James, Vivek, you want anything else to add before we talk about Link?
Good, James, you want to say something?
Well, I just have a lot of respect for Lane. I'm really grateful that he's been able to give his time to us today. I think I first met Lane, I think it was a year or two ago at one of the local conferences here. And then I was just really, I had heard of him on a lot of podcasts before, and he's just very intriguing because he was kind of a young guy. He's also in an engineering job, and I could just really relate to him. And he's been really just kicking butt left and right ever since. So I'm just really looking forward to having him on the call. And we have some things we'd like to discuss with him, but just super grateful for Lane to come on and share some of his knowledge and experience.
Yeah. Are you guys all engineers? I know Henry is.
Yeah, I'm an engineer, so
Yes,
I guess some of us on the call are. But yeah, I've been following your blog, Simple Passive Cash Flow, and also your podcast. I myself, my name is Vivek Arza from San Jose. Been investing in apartments, looking for deals and all that. But yeah, really fun to share all knowledge and learn from like-minded folks, like so many on this call. Thanks, Lane, for joining us, and thanks everyone for sharing your evening with us.
All right. Okay. So I know we're gonna have the breakout room time get to talk a little bit more about what you're working on and have a good chat conversation. So this portion, we're going to be asking Lane some questions or have him just share some of his insights on what he's working on. So let me give a quick intro, Lane, and a lot of people knows Lane in the industry. He's kind of been an expert in the area. So I remember he started in the early, I would say, or in 2000 or even earlier, has decades of experience in real estate. I think he now own over 4,000 plus stores in 9 U.S. markets. A lot of people know him by his podcast and his website, Simple Passive Cash Flow. And he also runs a mentoring group as well and coaching program. And he started in engineering. I think we're going to talk a little bit about that. And he has a professional engineering license, was also a project manager for some private and public sector before he jumped into full-time real estate. Is there anything else, Lane, that you would like to share with us on kind of how you get to here?
Well, I mean, I didn't all start there, right? Like I lived in Seattle since went to UW, went to school to be engineering, and bought a house to live up in Maple Leaf. You guys are familiar with that area, just below Northgate, back in 2009, and then just started to rent it out. That's where I got the taste of cash flow. And then I bought a duplex down in Del Ridge, South or West Seattle, and that was my next couple of units. And then I realized, rental value ratios don't work in private markets, and that was where I would start to go remote. And that was kind of when things took off from there.
So what was that big step from investing locally Like I think a lot of my friends are, why invest out of state? We know the market here. Seattle is doing great. Why? What kind of makes you to make the leap?
Well, I mean, just numbers don't make sense, right? It doesn't cash flow. Things are great until it doesn't when you're investing for appreciation. So I definitely wrote a little bit of that for a few years there, but I just thought to be more prudent to invest for cash flow. Um, and so that's, probably around 2012, I was looking to buy out that fourth unit up in Washington. And I was just like nothing cash flowed, right? Even if I went to more speed and C class, went up to Everett. And mind you, I'm working a full-time day job. So I'm not like one of these bros that goes out, has a billion hours to go and look for like distressed properties. My highest and best use was at my day job. And so didn't have too much time to commit to dumpster diving for really good deals and then putting all this equity up to rehab it and spend my time doing that. Even though that was very much my day job, right? Managing contractors, playing that dance, unforeseen conditions, all that nonsense with contractors. I didn't want to do that with my own money. So I even tried back in Seattle, I don't know if they still have them, but they have like auction houses and you're able to go and, buy more distressed property there. But then I looked around the room and it was just a bunch of like old Microsoft dudes who were super unsophisticated and had a boatload of money and didn't know what the heck they were doing. And I realized I needed to get the heck out of that room and where they're all building each other up and they're just going for their free, like lame spaghetti free dinner. So that was where I started to realize, I probably should just invest where the numbers make sense and bought that first property in Birmingham. And the way I do things is like, once I get proof of concept, I start to kind of go all in. So I 1031 exchange my three Seattle units for 9 out of state. So around 2015, I had 11 rental properties across 4 states. And that was kind of the next pivot point.
Yeah, so it took off from there. So if I ask you, are you looking only for cash flow and appreciation is nice to have, or what makes you decide that it's best to go over for cash flow?
I mean, in the beginning, from 2010 to 2019, my goal was to quit my day job, right? And to do that, I need cash flow. Taking these big home run swings, buying a house for the 300 grand in Seattle, seeing it go up to 700 is great. I call it gambling though, but it's not going to put food on the table every single month, right? It's not going to allow me to fire my boss. So I went after cash flow. And that was why I did what I did. Not going to say that I'm investing for appreciation. I think you can probably do better, but I just think that there's a more risk element that I'm just not willing to take. I want the property to kind of support itself on a month-to-month basis.
So Lane, for investments now, after all those units and years, are you still focused on that cash flow heavy element of an investment?
Not really, because I'm rich and I don't have a day job anymore. Right? It's different, right? And I think a lot of people don't realize that they kind of listen to what people say. I mean, I don't care what Warren Buffett does, right? I don't care what the guy's $6 million net worth does. I kind of follow people that are in a certain pedigree, or what I call like simple passive cash flow journey, right? Everybody's different pieces of this journey. When I first started, I just wanted prudent cash flow. Now I don't care. Like if I put 50 grand in a syndication and I get 4 grand a year as cash flow, I don't care, right? I don't really care.
Right. Different objectives at the moment.
Yeah. So like I've kind of moved, now I'm kind of going into a little bit development type of deals, but those developments aren't luxury type. They're more affordable housing, but they're new builds. But the nice appeal, and I see why accredited investors do this, is like, instead of in a stabilized cash flow apartment deal where you're rehabbing units for 2 years, you're stabilizing and you're exiting in 5. In these deals, you're getting a bigger equity multiplier, like a 2x equity multiplier in 3 years instead of a 2x equity multiplier in 5 years. But you have to forego cash flow to get that. So if you don't care about cash flow, or when I talk to a lot of my investors, my first 2 questions are, number 1, how stable is your day job? Do you have a good stable job, you got food on the table, then yeah, go into question 2, which is like, will your spouse give you crap if you put money into a deal and a year later you don't have anything to show for it because you're still building the thing, right? But if both of those is cool, you might as well just roll the dice and go after the bigger equity multiple. But I just kind of my standard advice for people getting started under $1 million net worth certainly is just go after cash flow.
Nice.
Hey Lane, so just taking a step back, you said you had 9 or was it 11 single family rentals out of state?
Yeah.
Yeah. So what was that mindset? Because a lot of people getting started, right? They think that real estate, you can only buy real estate actively and you have to have a property manager, all that baggage. What mindset or what pushed you into looking into syndications or multifamily? Was it scalability or something else for you?
Yeah, so when I had 11 rental properties at a few $100 each, you can do the math. That's about, say like a few $1,000s of passive cash flow a month, which is great, right? I mean, I would have killed to do that when I was 22 to 25, right? Like that's awesome. That's like a third paycheck a month, tax free.
Correct.
But I mean, what family can survive off of $3,000 a month? And with 11 rentals, I had an eviction or 2 every year, some kind of big catastrophe that happened every quarter, like a plumbing leak went into
like
the
a surprise
basement.
event, huh?
Yeah. But your property manager, does all that dirty work for you. And yeah, it probably just means like 2 or 3 emails back and forth over the course of a few weeks. But, I mean, you start to see the writing on the wall, right? Like to get more to like a $10,000 passive cash flow a month, which is more of like the goal most people have, you're going to need 30 of those properties. So multiply all those numbers and headaches by 3, and you quickly realize it's not sustainable. And what's worse is, this is a kind of a good problem to have. Is like once you own properties, they appreciate and your tenant's paying down your mortgage. So you have this phenomenon where your return on equity is coming down. I mean, the biggest sin of investors is to own properties and never sell them or never refinance and get the equity moving. That return on equity is important. That's what sophisticated investors look at.
Correct.
And it's impractical to do with like all these freaking like rental properties all over the place. And yeah, man, I was there. I thought like getting 10 rental properties, get 10 in my name, 10 in my wife's name was like the cool thing to do. And I look back and I'm around circles of people who think the same way. Like that was so silly. Why were we doing that, right?
But yeah, I mean, as long as you can pull the equity out and to do that, you need really good deals. And that's not the highest and best use of your time, which you alluded to at the beginning of the call.
Yeah. I mean, cool. If you want to like go and find deals, you're doing like direct mailing, you can. But I'm in another mastermind, Collective Genius. These guys flipped 100, 300 properties a year. I mean, I don't even want to compete with these guys. These guys are the freaking pros. Like, there's no way a mom and pop investor sitting at home right now can even compete with these guys. These guys are unloading like $3 to $5 grand of marketing at least per month. I mean, I think the guys in San Diego are unloading San Diego or San Francisco, they're unloading like 10 grand in direct marketing a month. It's unreal. You just can't compete with these. These are the pros out there.
No, that's absolutely right. Yeah, because I mean, you're competing with Goliaths, and you're looking for those 4 or 5 properties. They're looking for 400 or 500, and they're just playing a different game.
Yeah.
Coming to syndications, and I did notice that you said you were doing developments as well, because that's sacrificing cash flow right now for a higher multiple in 3 to 5 years. How do you see construction performing during this cycle? Because one, we have the pandemic, the recession. Any thoughts and some color there?
Yeah, I mean, first thing, like in a pandemic, earning uncertainty, like nobody wants to do anything, right? So now your competition is mowed down around you, right? So that helps you once you get going. As far as like, it depends, like I think when people normally think of construction, they think of risk, uncertainty, right? But depending how you structure your contracts, I mean, we'll use like a guaranteed maximum price contract where it costs a little bit more in the beginning, but we lock in our pricing and we send the risk over to the contractor and their subs. So, there's ways you can kind of get around and just kind of de-risk yourself. And at the end of the day, it matters how much margin you have in your numbers and your budget. Right? Like I think from a very surface level, a stabilized asset that's 92% occupied, cash flowing, clean financials for T12, T24, you can see that it looks stable, but it could have thinner margins than building something from scratch.
Right. Because it might just be costing very close to break even, or I mean, in multifamily syndications, usually anything over 85% is usually where the cream is. And developments might have higher spread.
Yeah. Like, so for like the stabilized deals that we do, we can like bomb the occupancy down to like 50, 60% occupancy and still be able to cash flow, which is awesome. And that's how we solved the pandemic. Normally we're at 97% collections, and maybe at worst it went to 92 in some of them. But in the developments, like once you build it, assuming you're raising all the capital up front and not having the investment sort of burn on fumes to come up with the rest of your development money and your operating budget, you're raising all the money up front. I mean, you could probably run that thing at like 20% occupancy or 30% occupancy and still make money. Right? And that's how I do kind of the sensitivity analysis after the original analysis is done. Like, how badly can this thing operate and still make money? How big is my margins?
Yeah. So then, speaking to occupancy, and I would assume this would change depending on if you're a cash flow heavy versus appreciation heavy deal, but are there any certain kind of like laws or lane laws or like metrics that you generally use in evaluating a property? Like what filters you may have in place to say yes is a good deal that we'll do or no?
I mean, I put everything in my spreadsheet, right? It's just a model. It's not like one thing is the thing to point out. But the driver of like the returns is pretty much undervalued rents, right? Unrealized net operating income increase, right? But it's hard to say. Like I know what you're asking, right? Like you're like, I mean, most accredited investors, LP investors don't know what the heck they're looking at. So you're asking like, all right, what's the cheat sheet here, right? What can I look at to seem like I'm sophisticated? To at the very least, what can I do to at least not go into a sucker deal or a daisy chain deal that gets sent around via email to 50 people? Really, the only way to do it is get the raw data and you know how to decode the code, right? So get the T12, get the red rolls, run it into the analyzer and kind of run the deal at your own assumptions and see what comes out the bottom of the page. But I mean, there are a few things like, you can spot check that I have a lot of my guys, we teach about like, looking at their reversion cap, right? What are they using for rent assumptions? What is full occupancy? Are they even assuming that there's going to be any economic vacancy, for example, right? Like those are the small things you can kind of check.
Right.
I think I'm creating like a each course on this, like some kind of cheat sheet or a checklist for LP to go down this list. But those are the things that you can kind of spot check to at least know you're not going into a sucker deal.
Right.
There's so many tricks, right? There's so many like little games.
5 tips to go into your 5 tips.
Yeah.
But by and large, it's kind of like really like a case by case in terms of saying yes to a deal. It's like overall, everything taken into account, like this looks good or is projected to be good kind of thing.
Yeah, part of it is just like seeing deal flow, right? Like after you see a bunch of it, and somebody points it out to you, especially now you're aware of like the nuances and the tricks and games.
Of course. Yeah.
Okay. Yeah. Once you see enough deals, you'll know where you can manipulate numbers and make the returns look good, while hiding a lot of things in the numbers. Yeah,
I mean that's why it's hard, right? Like unfortunately, a PDF pitch deck, you can get any like Filipino VA to do it for $20, right? Work 4 hours on it. I mean, this is the age that we live in. And then none of the back end assumptions are in those pitch decks. It's always like what came out the end of the spreadsheet, what it came out the tailpipe. Yeah. So it makes your job really, really difficult as LP. Most times the sponsor won't share the raw data. Why would they?
Absolutely. Yeah.
Right. you got to read between the lines or data points, so to speak. So they kind
Yeah,
of
or
the process.
the best way to do it is like, I mean, you got to build relationships with more accredited investors that actually do this stuff, right? Like that's the gold standard. I mean, I've been burnt before, but it was always because it was just some random referral, and that come to find out that person didn't even invest with that person in the first place, and I couldn't verify track record. But I think that's a lot of people in the beginning. I mean, who has a network of other accredited investors or people who do that? Who even has a network of people buying rental properties? Hardly any.
Yeah.
Helene, just wanted to touch upon one of the things that you describe on your blog. The reversing the pyramid of traditional investing. A lot of us do invest in the stock market and all that. Can you elaborate on what you mean by that, like reversing the pyramid?
Yeah, it's kind of like how I was saying earlier, like when my initial goal for my first 5, 10 years of investing out of college was just to invest for cash flow, right? Which is the complete opposite of what we're all taught. Like normal financial like wisdom is, put your money in this 401k, and then they call it the accumulation theory, right? You build up $2 to $4 million, and then you get it up to some magical number, you know, yeah, $2 to $4 million or whatever, and you withdraw it at a certain amount, which is stupid. It's just stupid because when you're in retirement, you need cash flow, right? So why not begin with the end in mind and create these streams of cash flow today, mini pensions, so that when a pandemic comes and takes your one source of income away, you have all these mini like income sources ready to go, right? So this is kind of reversing the pyramid, right? You need to build your pyramid with prudent cash flow on the bottom. Then once you get to be about $3,000 to $6,000 of cash flow, now you can kind of open things up and go invest in developments, marijuana parks, or whatever you want, right? That's where your risk tolerance gets wider, right? Too often, young people, they go after like Tesla stock or like sexy things or like things that aren't prudent, boring cash flow plays, right? They go after like this high flying stuff, but it's the complete opposite, in my opinion.
Right. A lot of it is speculation as well, because one thing in real estate, you might have a little bit of control. If it's your own property, you can make decisions, but nothing wrong with investing in the stock market, but you have zero control on how your investments are doing as someone who's invested in it.
Yeah. I mean, and it also depends, right? Like I kind of work with high pay professionals, and a lot of my guys make enough money. They're certainly able to save more than 30 to 100 grand a year. So they're at a position in life where they just invest their money prudently and stable investments, double their money every 5 to 6 years. I mean, they'll be all right, right? They'll be out of their day job in a decade. But yeah, if you're, if you're a broke guy, maybe you should go find a job, or I don't know. I'm not the guy to ask for that, and I don't want to sound like a dick or anything like that. But yeah, maybe you should go swing for some home runs, right? That's where I'm talking about the different paradigms here, right? Different advice for different folks. Like if you don't have that much money, you got to make some money, and that may mean like taking some Hail Marys. Just like when I play like Texas Hold'em, I don't like poker. I think it's boring. So what do? I just go all in on the first hand. I don't care, right? In a way, if you don't have any money, that's what you should probably do, right?
Yeah.
But for working professionals that make a pretty good salary, dude, you're just gonna like, you'll be all right. Like you just have to hold out for like 5 to 10 years, and you'll be in a much different position.
Right. No, absolutely.
Yeah, I really liked what you said earlier about like your highest and best use. Like, and maybe it is working at a job. Maybe it is going into real estate full time. Maybe it's a base hitter versus a home run. So I think that's helpful for passive investors because I always look at like different opportunities, whether it's stock, real estate. And it's like, what's the best use of my capital? And if it is in real estate, it's like there's even more variety in real estate. So you can go into like kind of two different ends of the spectrum, like cash flow versus new construction. So in terms of like deal pipeline for you, are you seeing any like shifting in terms of the types of opportunities that are presented to you? as a result of COVID or any of the economic changes we've had, or just really anything that's happened in the last several months? Like, are you shifting? Are you shifting exclusively to new development? Like, what's kind of the change in your deal pro forma, if you will?
Yeah, so I mean, I've been in a lot of Class C deals, and they struggle because your tenant base sucks, right? These guys don't pay, their collections is really hard. And for those of you guys who've owned $50,000, $60,000 properties that supposedly you're supposed to collect $900, $850 rent, you guys know that that's not how a Class C works, right? No different than a Class C apartment, right? It's a high paying type of asset class, even though the returns are definitely there. So for like, I'm probably going to stop doing Class C deals and stick to more Class B tenants or A- tenants. Definitely stay away from the luxury, the high end type of stuff, the $1,400 to $1,600 a month rents or higher. Definitely stay below that. But I am kind of going like less risky on the stabilized apartments, going to the Class B tenants and comboing that with maybe a third of developments, right, for my reach stuff. So 2/3 cash flow, Class B, boring tenants, and 1/3 development. That's my investment philosophy. Again, that's different than anybody else's, but based on where you are in the journey. But that's where I'm going to. As far as like deal flow from like syndicators, I'm seeing like it's harder for people to do deals these days because, quite frankly, LP investors are afraid, and a lot of people just can't raise money, right? Like, I mean, my capital group, we bought the Rockefeller in March, or not, and we kicked it off in March and April, and that was like hard because like my capital raising ability got caught in half because of being caught by a pandemic.
Yeah.
So, I mean, I'm all right because I can kind of raise a lot of money, but I saw just other people just drop like flies, right?
Yeah.
Are you seeing it coming back slowly, or has it changed?
Well, I mean, it's just all LP and investor mindset, right? Like a lot of my investors, they understand the way I invest is off prudent cash flow, right? So they get it, but maybe somebody else, they might not be able to tell to their investors or they're not going into those deals in the first place. Another thing in the underwriting that's happening in the last couple months is like the Fannie Mae, Freddie Mac lenders especially are making us hold like quite a bit of cash reserves, like 6 months of extra payments. So, I mean, that could mean like $300,000 to $500,000, $600,000 in the bank locked up for 6 months. So that's buzzkill for sure. That's diluting investor capital. So that again, you're not hitting those numbers to come out, and that's eventually your buffer. So, yeah, I think that's slowing things down. And then I think like people always you hear a lot about like foreclosures are coming. Everybody wants this have some kind of like soundbite on a podcast or like a YouTube video and saying, yeah, it's coming, 2021, 22, there's going to be a lot of distress, right? Like, I don't care. Like, I don't buy non-stabilized assets, right? Like, I buy properties from sellers with problems, not properties with problems, right? Like, the distress is going to come from these guys who are taking the deference and their tenants are paying. So the tenants are basically becoming bad citizens for our eyes, and that property is becoming more of a C-class property. And I just wouldn't buy it. So from my point of view, I don't care. But yeah, if you're more of a opportunistic investor, I think that there definitely is going to be more inventory coming online, but you're more of an active investor, and I don't want to touch that stuff. I think the mistake is if you're an unsophisticated LP investor, more passive investor, yeah, there might be more distressed inventory out there, but you ain't getting your hands on it if you're not getting your hands dirty right now.
Absolutely, yeah. At this moment, I want to just introduce a poll just to see if we can get some mood or temperature check of the audience. Henry, do you want to launch the first poll, maybe?
Yeah, you guys tell me. Would you guys want to invest or?
There's a poll out there. So we have one poll now and one poll near towards the end before the breakout rooms. So I think you should see something come up on your screen. The results are anonymous, but we can display them once the results are there.
Yep, and also feel free to ask Elaine a question. It's not just a couple of us asking. And yeah.
Yeah. How long do I think the economic downturn will last? Well, I don't care, right? Because I buy with existing cash flow in place. I don't care. I don't care. But I mean, I don't know. I care more because I want to get traveling. I gotta go to Japan and eat some sushi. Or at home. So I'd say another 3 to 6 months.
Yeah, when we were first evaluating cash flowing properties in the beginning of the pandemic, we would like ratchet down the occupancy for prepare for COVID. But now that we're now in August and September and now going into October, some of those properties actually kind of maintain their cash flow. So it's like, oh darn it, we should have bought it. So, but it's like I think what you said is kind of true. Is like if you buy properties with like management problems. Rather than tenant problems, I think you have a lot more resiliency in terms of the stability of your NOI at the end of the day, because you're not going to have that drop off factor due to a economic or other reasons. So that was a great point that you made.
Yeah, and I'm not buying properties in blue states. Heaven no, right? I only buy properties in red states because those guys are just. They're not little whiny babies, right? Like, you didn't pay my rent, I should get the government handoff.
Yeah, it's
right?
quite amusing to see how many reviews, which are almost exclusively negative, by the way, but they're like some of them are extremely long and detailed, and it's really a rant letter.
Yeah.
And then the positive ones are like, is great, I love this place, or something even more generic than that. It's just when people are angry, they're very vocal.
Yeah. Yeah, that's like one of the biggest mistakes LP investors are like, oh, I went to apartments.com and it was like 2 stars. I'm like, well, yeah, that's why we're buying the freaking thing, right? Like, nobody who's happy. Like, I love this 3-star, or I love this like $850 apartment. I just love it here. My person who gives me my Amazon boxes in the corner because there's it's a Class B apartment. I love it. They're so friendly. No, that's not how people are. Right?
Yeah. I think we got some good data.
Henry, how do you share the results? Maybe that's just you who has.
I think it's shared. I think everyone now can see what the results are.
Okay.
But we don't have that. Everybody put in their opinion, but looks like there is I think the feeling of around 12 months or longer.
Being a long haul.
Yeah, a little bit longer haul. I mean, most recession lasts more than 2 years, right? If we're going back to a regular recession, I'm not surprised we're going to go do that. It looks like of course, everyone here is interested in real estate. A lot of people are holding cash for sure and stock as well. The stock prices hasn't really dropped yet. I mean, it kind of came back even for the peak for NASDAQ, but kind of feel like something is going to come. We'll see. I don't know. I think Yen has been written something about that. I would kind of ask her opinion here was, and then real estate prices might slightly decrease or even more significantly decrease. So yeah, it's good data. So does anyone else have anything you want to ask Ling before we go into breakout rooms? Ling, any kind of wisdom, insights you want to share with us, or what do you think? You said you don't care about what's going to happen, or maybe does the election matter, or do you think it's a critical election, or it doesn't really matter to you?
I don't think it matters. I mean, the Congress controls like all the laws anyway. I mean, as sophisticated like accredited investors, you should know what the laws are and move to where the puck goes, right? Like, and it's like as sad as it sounds, like it's heads I win, tails I win. Right, I know all the little tricks and games, and we all see what Trump does. I mean, we've been seeing that stuff from accredited investors for years, for decades, right?
Yeah, unless like 1031 is taken away by some slave hand, because
I don't care. I don't care about 1031s. 1031s are like one of the worst things I've ever heard about in my life. I don't know why anybody does them. With bonus depreciation, you just offset your active your
Oh, you don't have to
your
even worry
gains.
about it in the future. Yeah.
Right.
Yeah.
There's so many people that are like, I have to buy this property now, because it just puts you in a bind, really. I kind of agree with you on that point.
It's just that's one of those things that's being like so oversold by like people who do that, the custodians. Of course, the
Big
10-to-1
headache
custodian
to
is going to sell custodians, and people get it in their mind like that's just one tool, right? It's just like a QRP. QRP is just one tool, and I only tell people to use it maybe in 10% of situations.
Definitely a purpose, but not an exclusive.
Yeah, I mean, it's like debt, right? That's a tool. You can use it in the right way. You can use it in the wrong way.
I've got a question. Kind of going back to the Class C product, all the hassles of managing a Class C product, particularly, let's say, tenants not paying rent or being unpredictable with paying rent, and just given the age of buildings, certain kind of infrastructure stuff that might come up that fixing doesn't necessarily increase your rents that you can get. Do you think that's already like priced in, which is why Class C, you get the higher yield, or do you think it's not really like appropriately valued in, and it just needs to be underwritten, and therefore the values, you need to search for, you need to find deals that better reflect all that hassle?
Well, every deal is different, right? And we only buy like one deal out of 1,000, right? But let's just talk high level, right? Average normals. I think Class C deals are just like accessible to more people, right? And when we were doing Class C deals, we had to raise $2 million, $3 million to get the deal done, which was like hard for us. But now we can just raise like $8.5 million in a few weeks and go after a better asset. So part of the whole thing is like it's just out of reach out of more people, I think. And like I said, like I'm not saying that you can't find better returns in Class C, but as an operator doing the hard work, I don't want to do it.
Yeah, and I guess that gets at your point. I forget how you exactly say it, but kind of where you are in your real estate journey. I mean, if you can only raise $1 million or $2 million, then, as somebody once said to me, you get in where you fit in. And if you can raise 8 million, then that changes the landscape.
Right. Take what you can get. I mean, yeah, I mean, it's unfortunate because the Class C deals are like where you cut your teeth. It's like your first job. It sucked. It was hard, but it's where you learned the most. But yeah, you're not doing it now, right?
And just to add a little bit, Peter, like we've seen Class C cap rates almost compress to the point where they're very close to Class B. And even the price per door has been so high. Plus what Lane is saying, I mean, add that on top, like the operation of it is so challenging. I think that is an added risk, if you will, because one, it's hard to operate. The buildings are old. There's more risk and more repairs. Plus, you're paying premium because they've compressed so much. It's not too different from Class B deals, is what we are seeing in the markets anyway.
Yeah. Again, you got the Microsoft guy with too much money coming in, right? That's the phenomenon that's happening, right? Class C deals are accessible to most mom and pop investors.
Or single investors, single wealthy investors, if you will. Yeah.
Hey, so I think, go ahead.
Sorry, I have a question about this new construction. So you talk about one type of risk. I think it's like the construction side of risk, how to control the cost. That part I get it, but there's another side of the risk. So when you sell, for example, you build it and then you sell it, but when you sell, you don't know when the market condition will be. So how do you assess that part of like market risk?
Well, that's why you don't, like when I say development, I'm not selling any residential property, right? Where that just sells off comps. I'm creating a commercial property where we're creating that income stream, right? I don't care if we're in a pandemic or a zombie apocalypse. Commercial assets will trade for a cap rate, whatever cap rate they may be. So it's predictable, right? We're creating a building that just so happens creates an income stream. And that income stream is what dictates the price.
Got it.
So it's not like when I see when I see a lot of bad development deal pitch decks, it's like they come up with a sales price and just pulled it out of the butt. It's a guess, right? They might have gotten some comps in a circle, but the way I want to do it is like, well, what does this 150 unit that you're going to create at $1,200 rents, what is that income stream going to be? And that's very predictable. And then that's what you divide by the cap rate of 5% for your Class A, and that's your purchase price. That's your sales price.
Yeah, I think viewing the property or investment as a business, for that's what it is it helps make that mindset different of like we're pricing it on what it can produce, not like really what it is necessarily, but it's like how productive of an asset is that, and then how much are people willing to pay for that, as opposed to like it's in this location or it has this structure. It's just different, like from residential. So,
but you're very right. Like if it's residential, yeah, it's just a wild ass guess what that thing is going to sell for in the future.
Yeah.
Right. Building a property on the west side of Shoreline, right? Or, I don't know, like $700,000-800,000, right? It's still a wild guess, right? It's nothing. It's just, and that's risk. I wouldn't do that. It's very much speculation. And I think that's where investors, they need to realize that's why you go the commercial front, right? Because we're not speculating on the commercial front. You speculate on the residential side. If the economy goes up, who wins the election? Yeah, I think that kind of stuff has into play because it's based on comps, and comps is based on emotions, and emotion is based on random people who either wear masks all the time or they don't, or they think someone's stealing their DNA. Like people, you just want to take people out of it, right? Get into the commercial realm.
Yeah, I like to view like the equities market kind of like on a spectrum of how reflective of human emotion something is. It's like you have equities and then you have residential real estate and then you have commercial real estate, where it's like we just care about cash flow, and then here's like, well, what's the market doing? Like it's just this amorphous mass that you have no control over.
Right, says the engineer, right? Who's like, no motion, right? No smiling.
I like commercial, yeah. Yeah. So.
Okay, so I think it's probably about time we can start doing the breakout room.
Hey,
So,
Henry, I've got to hop off to this other meeting.
Okay, all
But
right, Peter.
hey, Lane, so nice to meet you, and nice to see everyone else. And I'm signing off.
Thank you, Peter.
Appreciate
Thanks,
it.
Peter.
Good questions.
All right, so we're gonna have 10 minutes each, and then we might just do 2 today. All right, so I'm gonna start putting everyone there now, and just get And we have a guest, Lane